Confidence. You want to make decisions in your business. You want to have the confidence to know you're making decisions based on real information. So you've got to keep your finances up to date so that you can make decisions. Viability, profitability. You want to know, is your business likely to be profitable? For new businesses, when will it become profitable? How profitable is it likely to be? How much money do I need to make sure I don't run out of money? And later on down the line, when you're expanding, you want to forecast what it's likely to cost, what the likely return's going to be, and then you want to monitor that to see if it's working. Feasibility. In terms of finance, have you got enough money to do the things you want to do? If not, you will have to raise money, and better to do it with confidence, knowing you're basing it on factual information. Funding. If you need funding, you're certainly going to have records to show why you need it. Expansion of your business. Again, that normally requires money. It normally means a pre-start stage or a development stage. It normally means money goes out before money starts coming back in again. And if all your money goes out, there will never ever be a time when money is closed. Tax planning. To know how much tax liability you're likely to have. So that when the tax authorities say, we'd like you to pay your taxes now, you've got the money there to pay it. There's no good saying to tax authorities, I know I owe you £3,000, but I don't have it. Can I pay you one day? They're going to say, no, we want it right now. So you've got to be salting money away into an account so that when the tax man says, pay up, you've got the money ready to pay. So you need to plan approximately how much tax you're going to be liable for, and you need to have that money ready. And more generally, cash flow. Making sure you're managing the business from a cash point of view and that you're not likely to run out of money. Because remember, in business, that is fate. So, lots of good reasons why you want to keep your finances correct. Is your business idea worthwhile? Can it make a profit? How much profit? When will it make it? Is it going to be worthwhile? You may be putting money into this business. You may be putting a heck of a lot of time and energy and health into this business. You want to know, is it going to be worthwhile? And then you're going to monitor that to see if it is worthwhile. So, financial control of a business. How do we keep financial records? Well, there's a variety of ways. There's the old shoebox philosophy. I'll just throw everything into a box and one day I'll get round to sorting it out. That is not one we recommend. Keep your records up to date. Most small businesses are not that busy in the early days. So you've got time to keep your financial records. And remember, if you keep your financial records up to date, the decisions you're making are an awful lot better. So don't use the shoebox philosophy. There's other ways. You can keep your records on a notebook. You can buy a little notepad and just keep a record of your sales and your purchases. You can use toilet paper if you want to, as long as you've got some evidence there to show the records you're keeping. Most businesses use analysis books or analysis pads or cash books and ledgers. More commonly, they do it on software. So they buy software packages. Business advisors will help you here. There are different packages and some of them suit different businesses better. So business advisors will generally recommend to you the ones that would suit you. You can also do it yourself. If you're good at Excel or numbers, if it's iPad, then you can keep records yourself. You can make up the spreadsheets yourself. And again, advisors will help you here. Financial control is basically about these three areas. Is my business profitable? If the income's more than the running costs, you're making a profit. If the income's less than the running costs, you're making a loss. It's quite simple. Remember, that's based on when transactions take place, not necessarily when money changes hands. You want to know, what's my business worth? You want to know when you wake up one morning, am I worth $1 million yet? Or it might be that you want to use your business as a security for a loan. You might be able to get a lower interest rate if you put the business up as security for a loan. You'll want to know what the business is worth so you'll know how much security it can offer you. It might even be somebody comes along to you one day and says, I want to buy your business from you. You might get a phone call saying, this is Richard Branson here, I hear your business is very successful, I'd like to buy it from you. You want to know how much your business is worth so you can start negotiating a sale. So you need to know how much your business is worth. Most importantly, do I have enough money? Have I got enough money to keep trading? Because if the answer is no, end of business. So we want to know, is it profitable, what's it worth, and have I got enough money? And we keep records for these. We keep a profit and loss account to let you see if you're making a profit. We keep a balance sheet that tells you the value of your assets. That's what you own or what is owed to you. The value of your liabilities, what you owe to other people. And the difference, the capital of the business. So as long as you own more than you owe, you're solvent. If you owe more than you own, you can't pay your debts. You're technically insolvent and you should cease to trade. And most importantly of all, you want to make sure your business doesn't run out of money. So you need to keep records for each of these things. So, what sort of information do we need? What records do we keep? Well, in terms of cash flow, which is the most important of all, we need to know how much money is owed to us. We need to know how much money is actually coming into the bank. We need to know what money is going out the bank. And we need to know what money we owe to other people and when we've got to pay that. So we keep a cash book. That's actually a misnomer. Cash book. It used to be a cash book. Once upon a time, long time ago, people actually dealt in gold coins. They dealt in real money and they passed gold coins to each other in the trading. And therefore accountants call this thing a cash book. But more recently we've had checkbooks, we've had debit cards, credit cards, ATM machines, online banking. People don't really use cash money as much nowadays. But accountants still call it a cash book. Because they are boring old farts. It was called a cash book when it was invented and it's staying as a cash book. It's not really a cash book, it's a bank record. It's a record of the money that's going in and out of your bank. Most businesses also keep a petty cash book, which is a cash book, because most businesses keep a small amount of money in a petty cash box or in a drawer somewhere. You may want to buy stationery, you may want to buy pens, you may want to buy Friday Greg's, who knows. But you keep a little bit of money in the business, in a petty cash box, and you have a petty cash book that records what's going in and out of that box. The cash book itself records what's going in and out of your bank. We've also got a sales ledger and a purchase ledger. A ledger is just a posh accountant's name for a record. A record of the sales that you've made. When did you sell things? What did you sell? How much did you sell it for? And importantly, have you been paid for it? And you keep a record of your purchases. When did you buy things? Who did you buy them from? What did you buy? How much did it cost? And have you paid the bill yet? And that's the basic records that you need to keep for financial recording. So, what sort of information do we keep? On the screen here we've actually got two things. On the top we've got the cash book.